G'day folks, welcome back to another update on the US and the world markets. Now the markets have kept rising since the big fall last week, but currently we're showing a bearish divergence on all of them, and I'll go through those for each of the charts. Don't forget to hit that like and subscribe button and support us on Patreon if you want to support us more. Buy us a coffee there. Let's go to the heat map, and you can see there in the bottom left we've got the market still predominantly bullish after that massive fall last week, with the weekly showing a bearish move. And note the monthly charts are showing neutral positioning, which gives us an uncertainty on longer term. So it's all hedging on the daily and see where that goes. But again, we'll dig into that in more detail. So first, looking at the S&P 500 on the monthly, it's turned into a neutral position. You can see there the CCI's dropped into that moving average range of the CCI moving averages, although the price is still potentially making further highs. So very long-term bearish divergence in play, lower highs versus higher highs on the price. Now we haven't drawn a retrace level yet, but we'll do that as soon as we see a pullback on the monthly. On the weekly, same sort of scenario. We've got a bearish divergence, lower highs versus higher highs on the price, and that's already broken below the moving averages. So you can see there that's a bearish signal. But note we've also had a major upswing this week, and that's also reflected on the daily. If I zoom out on this one, you can see there the CCI is broken above the moving averages. If I put those moving averages in there, and that's a bullish momentum, and that's also bullish as well on the price chart. Now making recent highs versus this week, but we haven't reached this resistance yet at 5667. But if we drill into so for the hourly chart, again using the daily as a reference, you can see there it's bullish on the daily, so we only take long trades, and you would have taken long trades from the 13th of August. So if we put in our long arrows there, so from this period after our last video, you would have taken those little long trades there, small trades nonetheless, but still profitable. Exit there, another break above the moving averages, take a long trade, exit there, and currently it's still been a trade with this little move higher. Now notice a couple of things. We did have if I zoom in here, we did have a bullish divergence, higher lows on the CCI versus lower lows on the price. It bounced, and that hit our 23-38% target range, and that would have been the Fibonacci level between that low and that high. That's 23-38%. That's a minimum, and more than 90% of the time it hits that range. In this case, it's gone much further than that. If I zoom out to there, you can see there it's gone. Well, it's currently resting around the 100% retrace level. So that's what we look at in terms of the divergence. Now notice here as well, we do have another bearish divergence, lower lows on the CCI versus higher highs on the price. We did have a bearish divergence here, but notice we always track it and make sure it does retrace. In this case, it hasn't. You could probably argue, if you want to be really strict about, we take it back to the previous low before the divergence started. I don't like doing this because it's sort of almost cheating, but you can see there that little wick hit that 23-38% level. So that's what I'm saying. At the very least, it does that 23-38% retrace, and we currently have that same scenario here. So I'm not going to draw I will draw a Fibonacci just to prove my point. You can see that, assuming it pulls back from there, it could go higher before it pulls back, but that'll be the minimum retrace level if it pulls back from there. I don't like drawing them until I see a pullback begin. And now in this case, if the CCI keeps falling, at some point we're going to see the price fall as well. But at the moment, if I go back to I'll show you on here on the daily chart, just to prove my point in terms of these divergence. If I go back a bit of history here. So what I've got here is a history of the S&P going back to 1972. So if we work backwards, I've highlighted the key market falls or recessions. So beginning back here, if I zoom in, you can see there we had a couple of bullish divergence, that little one there, higher lows versus lower lows. The price bounced, hit our 23% target. I won't draw the Fibonacci's, but you can basically eyeball it. That almost went as high as a 50% retrace. This longer term period over those months, lower lows versus higher lows on the CCI. It eventually broke out, and that actually broke out to about the 50% level as well. That was a bullish move. So had you caught that move there, you could have actually started buying it when it broke above in this area here. Keep going to this area, There's a lot more bearish and bullish divergence across this history. Another bullish move here versus lower lows on the price. You can see a bounce there, but again, going back here, we saw a double top there. The CCI started falling off and eventually fell off. Another little bullish divergence there, started rising. A bearish divergence there, you can see there versus higher highs. The price fell off quite strongly. So again, it would have been wise to, if you're going to short that, take a short entry or get out of the long trade. Another little very minor bullish divergence, or a double bottom if you like, versus lower lows. Price bounced. In this case, it went much higher than the 100% retrace level. And over here we have another bullish divergence, bullish movement on the CCI versus lower lows on the price. Keep riding the CCI, wait for that to break higher. Now in this case you would have, let me draw a Fibonacci on this one. Once the price started retracing to the upside, you could have got in there. That would have been a false break, fell. But notice we had higher lows, started breaking higher. In this case, that's why I'm saying you want to wait for that Fibonacci retracement to the 23-38% level. Now in this case, it broke higher than that 23-38% level, and that's where you would have got in with a started going long on the market again. Another bullish divergence, and back here you had another bearish divergence. Again, read the divergence, get out of any long trades. The market declined. Here we had a bullish divergence, get back into it. That would have been roughly around a 23-38% level. Buy more there. Anyway, you get the point. And more recently, it was 2015-16, bullish divergence, lower lows, break higher. Bearish divergence, get out of it before that started declining. And this was back in during COVID. I haven't drawn a circle here, but you can see there, lower highs on the CCI versus higher highs on the price. Price fell off, and you would have been wise to take out, stop trading when those moving averages are breached and it breaks lower. There was no divergence there to talk of in terms of bullish divergence. But again, reading the CCI, you would have got in, assuming you were following the weekly, that would have been a break above that level around there. You would have got into long positioning there. So hopefully that's given you a bit of an insight into what to look out for. And there's some more bullish and bearish movement, and that's where we are today. We've got bearish movement on the CCI versus bullish movement on the price. It's actually hit that target area on the daily, and we may see further declines. Just keep an eye on that as per the weekly and monthly trends as well on the S&P. So this is the GermanDax, and using the same method as I just explained with the S&P, we do have bearish divergence on the monthly versus the price chart, higher highs versus lower highs on the CCI. That hasn't started to break down yet on the weekly. Again, almost a double top on the CCI and declines versus higher highs on the price. Now that actually, depending on where you draw that Fibonacci, there was a little Fibonacci retracement there. That pulled back. It's not that one there. So that would have been that little range there. Had another intermediate divergence there on the weekly. On the daily, we do have this smaller range Fibonacci retracement, had a couple of them there, broke into their range there, but fell below the 38% level, hitting this support at 1720, and it bounced from there. Now that's currently still in a bullish momentum on the daily. And if we go to the 1 hour chart, again taking long trades only, but again similar to the S&P, notice we've got a bearish divergence on the CCI versus higher highs on the price, and that's still rising. So I'd like to see that break to the downside before taking any short trades initially, but again, I wouldn't take short trades until we see the daily break below those moving averages if you're trading on the intraday. So again, always trade in the direction of the higher time frame. So if you're trading on the, if I go back to if you're trading on the daily, make sure the weekly's in your favor. So if you're going short on the daily, taking only short trades based on the weekly, and vice versa. So the Nikkei on the monthly has turned bearish. It's broken below the moving averages, although the price is still fairly high. And as a result of that big wick on the monthly. On the weekly, that's been bearish now for a number of months. You can see there it's hit our 23-38% Fibonacci retracement from that low. And it's bounced from there. And on the daily, it's actually broken up into a bullish momentum as per the CCI down there. So bullish movement if you're trading on the intraday. And if we go to the hourly chart, taking only long trades, again, putting those arrows in there. You can see you're taking a long trade when it breaks above the moving average there. You would have closed it out possibly with an exit there when it broke into that EMA 9, then go long again, and you'd still be in a trade on that one. So you can either take exit your trades when CCI breaks into the moving average like it did in those places. You can see there actually that was near the peak, or if you like, you can wait till it breaks below the close breaks below the exponential moving average 9 like it did in that place. So there's a couple of exit points you can take your exits. So for the NASDAQ, it's neutral on the monthly. You can see the CCI is broken into that moving average range. Hasn't quite hit our, and this also had a bearish divergence versus the price. Hasn't actually hit our price target yet on that bearish divergence on the monthly. On the weekly, and these divergence on the in different time frames are independent. They're not necessarily aligned. We've got another bearish divergence there versus the price, and I've drawn a target area there. In a very short term, we had a smaller bearish divergence. It hits the target there, it's bounced. And on the daily, and that's bearish on the weekly, and on the daily it's bullish. It's broken above the moving averages of the CCI and the price. So taking only long trades on the intraday. If we go to the hourly chart, again taking long trades during that period based on the daily, and you would have been going long in that period there, and you'd still be in a trade today with that still rising. So again, you could have taken exits when it broke on that red candle there, when it broke into that CCI range, and notice on the hourly, it's broken into a bearish momentum. So I wouldn't go short yet until we see the daily break to the downside as well. Or alternatively, if this breaks higher above the moving average of the CCI, and that's bullish on the daily, then you take another long trade. So hopefully that's been of help to you in terms of understanding where the markets may turn, using those divergence as a nice exit strategy. So support us more by hitting that like and subscribe button. And if you really want to support us extra, buy us a coffee, go to the Patreon page where we do weekly bullish scans of shares. Thanks for watching, and see you in a future video.